Another weekly wrap, reflecting on all of the recent news and share price action over the past week, while also looking forward to how the markets may react after a risk-on upwards rally and the first Federal Reserve rate hike of the cycle. This weekly wrap's going to be a little bit different. The past few weeks we've been talking about a downwards trending market, continuing uncertainty, almost peak fear in this current trend. But this week we had a risk-on rally. S&P 500 led higher by the technology and those more growthier names was up by over 6%. We saw a range of different risk-on assets pushing higher, including many of the Chinese stocks that had been beaten down over this past period. Of course, geopolitical uncertainty still did persist, and so today we'll unpack the current situation in Ukraine. We'll talk about the tech-led rally, and of course, we'll talk about the U.S. central bank's first Fed rate hike, and what that means for markets and the broader macroeconomic picture moving forward. For now, welcome. Hope you enjoy the video. Park up with a cup of tea or a nice coffee, and welcome to this week's weekly wrap. So I think first and foremost, it is worth us noting and addressing the fact that it seems like for now, peak fear has subsided. Over the past couple of weeks, we've been looking at both of these indicators as a bit of a contrarian look into where markets may be reaching peak fear and potentially what may be indicating a bottoming out of this current period. Of course, we don't know whether there'll be another leg further downwards. We'll have to wait to assess that. But we know for those who have been playing at home and watching over the past couple of weeks, fear went from 20 to 14 last week's wrap, and now we're at 37. So there's been an upwards rally. Fear has subsided. Of course, we're still in a fearful time. There's still a lot of macroeconomic uncertainties, but it seems like the market has been digesting everything that's been playing out. And of course, we've had a rally off the bottom since then. It is worth noting too that over the past couple of weeks we've been talking about the fact that the VIX, once it does reach 30, apart from a couple of anomalies and atypical situations, including the March 2020 period where the VIX really punched through that mark, but we have seen over the past 5 years really quite a strong trend that when the VIX reaches above 30, quite a strong trend to the other side. And this has actually been continued on in this period. The VIX traded above 30 over the past week, but now it's back to a more manageable 23 level. So it'll be fascinating to see where the volatility starts to subside, we start to see a more benign environment on that volatility side, or whether there's another trick left in the trade. I'm very keen to know your thoughts on it all too, so drop in a comment below what you've made of this past week. Do you think we're starting to see a bottoming out after what's been an uncertain period on markets? Or do you think this is just a counter trend rally and there may be further moves to the downside from here? And so with some of the topics over the past week, probably the first one that's worthy of addressing is the Ukrainian situation. Of course, the images, the videos coming out of it are still extremely difficult to really be able to reconcile. Unfortunately, we have not reached that peaceful resolution yet that everybody around the world is really hoping for, praying for, and we really do hope we reach over this upcoming period. It's up to the fourth round of negotiations now. Kiev still has not yet been captured. The Ukrainian forces are holding out strong on that front. Zelensky actually did speak to Congress and acquired additional support on that front. And we do know that there is this focus moving towards potentially neutrality in Ukraine, and of course Russia still wants to see a demilitarized Ukraine. It looks like Ukraine is open to neutrality with security guarantees backstopping that, but of course negotiations still continue on, and I think I speak on behalf of everyone where everyone's hoping for a situation that's solved as swiftly as possible, as safe as possible, and first and foremost with the humanitarian considerations at the top of the discussions. On that front, as we did start to see negotiations at some point over the past week move towards what looked like potentially a more peaceful resolution, we actually saw the price of oil start to subside. Brent, which got to $139 a barrel, actually pulled below that $100 mark, and energy prices as well across the board started to have a bit of a leveling out. But of course, we know that the energy sector has been very volatile over this past period. It really is at the whim of any of these discussions on the Ukrainian front, so there's likely to be continued uncertainty and wobbles as a result of anything that does play out. And then building on all of that, we know that the technology sector, that more growthier end of the market, has been some of the hardest hit after this correction around the boards. We know that technology sector with the NASDAQ as that proxy has entered into a bear market. However, over this past week, we really did see quite a strong rally to the north side. It looks like for now in this portion of the trend, we've started to see a bottoming out. Interestingly, slightly higher high compared to the last high that we did see off the bottom. So it'll be fascinating to see if this is a bit of a base for the move or whether we start to see a more moderated move over this upcoming week. It was actually tech's best week since 2020 for those looking at the past. Risk-on rally seen across the markets. Bitcoin had a bit of a bounce as well. We saw some of the risk-on currencies too have a move to the north side. And interestingly, Chinese technology stocks, which have really struggled over this past period, led higher by Alibaba, but many of these names as well, like Pinduoduo, as well as Tencent, all pushed higher too after the central banks in China announced that they would be supporting the markets in the broader economic picture. It's going to be interesting to see where things head from here. Do we continue to see a more risk-on rally? Do we start to see a more evening out? Will the NASDAQ be leading things higher? Or will it be a more value-oriented move over this upcoming week on the markets? There's a lot of different considerations, and we know, of course, that the growthier end of the market has, of course, been moving lower on the back of the threat of rising interest rates and what that means for the interest rates and discount rates used for valuations. Of course, we've got the first rate hike out of the way now. So the question is that enough for the markets to start to digest it? And have we seen valuations compress enough that now we can see the next leg higher? Or, however, has this been a bit of a bull trap, and now that the rate hike cycle has begun, will things continue to trend lower from here? And so with that question, that brings us to the Fed rate hike discussion. Before we unpack what that means and some of the insights around how that played out over the past week, if you've enjoyed the video, don't forget to hit the like button. If you're new here, welcome. We make daily videos, so make sure you've subscribed and turn your bell notifications on as well. So as we know, the Fed rate hike arrives. And what was very fascinating about that was we did have a bit of an indication that it was likely to be 25 basis points. Of course, there was discussions earlier this year about whether we'd see a 50 basis point rise, but the fact that uncertainty still persists in the macroeconomic picture meant that 25 basis points was going to be that level. But there was questions about how hawkish or dovish would the Federal Reserve be. We know that the backdrop for this is the fastest inflation rate in around 40 years, 7.9% at that top level for CPI. The Fed raised rates by 25 basis points. It was the first rate hike of the cycle, but interestingly, of course, getting the insights with the dot plot, this was a dot plot meeting, was that the Fed indicated that potentially they would have as many as 6 rate rises in 2022 before being followed by potentially 4 in 2023. We know we're looking for that neutral rate. There's no consensus figure on where that sits, but many analysts and economists indicate that it may sit between that 2 to 3% band. But what's interesting as well on that broader macroeconomic sphere is the 2-10 spread continues to compress and get closer and closer. We're not at the point of yield curve inversion, but economists are watching this anxiously, knowing that yield curve inversion has at times in the past, of course, been a leading indicator in terms of upcoming recessions. There's a lot to take in. There's a lot for us to consider. We did start to get some initial answers over this past week on market, but again, we're going to need to wait for further confirmation and insights over this upcoming period. We're at the end of a quarter. We know that the end of a quarter can often be quite symbolic in terms of changes in sentiment and changes in trajectory for sectors, cohorts, or the broader index level. So it's going to be fascinating to see what the month of April has up ahead. Hope you enjoyed the video. Thank you so much for joining us. Drop in a comment, let us know your thoughts. We'll leave some links up above to other videos that we've done so you can check those out after this one. For now, stay well and happy investing.